everyone. Today I'm going to be covering 3 stocks that I plan on buying in December. And I'm going to cover everything about these stocks, so it's going to be a great video. Plus, I'm going to throw in 3 bonus stocks that I'm putting on my watch list. And if they drop to a certain price, I will be buying those as well. Now, before we get started, I just wanted to touch base on this new variant that's taking over, Omicron, I believe it's called, and what I think is going to be the outcome. So the stock market obviously has had a negative reaction for about 2 days now. And what I predict, this is just a prediction, but I think that 3 things will happen. And these 3 things will be what turns the stock market around and makes people more comfortable. One is that the vaccination companies come out with solid support saying we're able to make a vaccine that will support this new variant as well and protect you guys against it. That'll bring some calm to the stock market and bring people back to buying stocks again, I feel. Second thing is, if they come out and say, hey, upon further research, this variant is no longer of concern. It's not as strong as we thought it would be or as transmissible, etc., etc. That would also help the stock market ease its fears and return to normal craziness like it's been. And then lastly, if things go a little bit towards the far end of fear and this turns out to be bigger than we think, then the last thing is I think the Fed will have to step in and make a move, and they'll do that if they need to. So I see the fears of this variant lasting anywhere from maybe 3 more weeks to 3 more months. So just keep that in mind. There might be some volatility in the market. All right, on to our first stock. We are going to start with the first stock that I plan on buying in December, and that's going to be Johnson & Johnson. Now, with Johnson & Johnson, they are in the healthcare sector, and they focus on pharmaceuticals, but they have 3 segments that they kind of go their business is under. That's consumer health, pharmaceutical, and medical devices. Now, the consumer health segment, recently there was some news, and we're going to cover this a little bit more in the end, but they plan on maybe taking this segment and spinning it off into a separate company. But right now, this segment offers baby care products under Johnson's and Aveeno brands. They have oral care products like Listerine. If I highlighted all the brands that probably stick out to you, so Tylenol, Sudafed, Pepsi, Band-Aid, Zyrtec, Nicorette. So they have a broad range of consumer health products in that first segment. Now, in the other segments, we have pharmaceutical, the pharmaceutical segment. So this is, they have products in various therapeutic areas, including immunology, infectious diseases, neuroscience, oncology, so on and so forth. And so there's, a lot there, I feel, and this is probably the segment that I think is going to offer the best growth. We'll get into that in a minute. Now, they have the last segment is medical devices. So this provides products to treat cardiovascular diseases, stroke cases. They also have orthopedics that support hips, knees, spine, sports, and other trauma areas. They have advanced and general surgery solutions. And also they have products related to cataract and laser refractive surgery. And they have the AccuView brand, which I think we've all heard of. So these are their 3 segments that they operate under. We are now going to look at their fundamental analysis. These are ratings that are offered, and they kind of rate on 4 different things. So the valuation, Johnson & Johnson is considered very undervalued, which is one of the reasons why I'm buying. They're a very high quality company, which is another area that I like. Now, their growth stability is a little bit towards the low side, and that's why Johnson & Johnson, I think, is going to spin off their consumer health segment, because that's their slowest growth out of the 3, and they're going to focus on the pharmaceutical and medical devices. So I think this will turn around eventually. Now, their financial health, they're extremely healthy, which is another reason why I am investing in this company. Now, analysts rate this at a 7.3 out of 10, so they're more bullish. There's a lot more buy ratings on Johnson & Johnson right now, and I think that's because they're a very sturdy, healthy company. And with this recent news, I think it adds to them becoming more of a growth story. Now, Before we move forward, I want you to keep this in mind with all three stocks. I'm going to bench these all against the S&P 500. Now the S&P 500 in the last 1 year is up 28.5%. That is impressive, that is super healthy, so just keep that in mind, 28.5%. Now with Johnson & Johnson, they're up just 10.5% over the last year. So a far cry from the S&P 500. But this is where I think with a pivot that they're trying to do, it'll send this stock going up pretty high. Now, as far as dividends, a lot of people buy Johnson & Johnson for a dividend. They currently have a dividend yield of 2.66%. That is, to me, a very healthy dividend yield, especially for a company that's pivoting to also be more of a growth company in the future. And so I like that they have a very healthy dividend, and it's higher than the whole S&P 500 average as well. Now, if we look at some financials, Johnson & Johnson's debt to assets is 60.8%. Now, I like to see, any companies that I invest in to have less than a 75% debt to asset ratio. And so this is still healthy. It's kind of on the high end. I like to see it closer to 50, but keep in mind, debt is not a bad thing unless if it's out of control and in my opinion above that 75%. That just means they're probably making moves to pivot themselves and position themselves for some growth. And sometimes you have to accrue some costs and take out some debt. So I think this is totally acceptable and no worries there. Now, as far as their cash goes, over the past 5 years, it was high in 2016 and then it kind of dropped through 2017 and 19, but last year it was up quite a bit. So that's a great sign. Their cash is improving. Now, as far as their debt goes, they have been on kind of an incline on their long-term debt. But again, I think that's just because they're positioning themselves to do big things. And of course, with pharmaceuticals, if you have drugs in the pipeline, you're going to have to spend some money to get those out to market. Now, if we look at their net income, it's kind of been relatively flat. Kind of hovers around the 15 range. And so, not showing the growth there, and neither in their earnings per share. It's remained relatively flat. Maybe a slight increase with their earnings per share. And so again, I think that's why the stock has kind of been kept low. People just don't see it as far as growth goes. Now, price target for this company on their stock. Right now, I think even today they've, it says 159 there, their current price, but I think they're down to like 157. But they're projected to be between 169 and 215 over the next year. So that is a really decent growth in this stock. And that's why I'm choosing to invest, because it has signs that this stock will jump. Yes, I know it's been a little stagnant, but I think with the action that the leadership is taking, it should turn around. Now, why I'm bullish? Well, it's mainly because of what I mentioned. Their consumer health business accounts for about 16% of its top line. That's the lowest out of the three segments. For medical devices, it's 29%, and for the prescription drug business, it's 55%. That's huge. So I can see why, and I agree with them, spinning off the consumer health side of things and focusing on growth. It's going to be a really smart move that this company does. You just wait and see. Now, they're also saying that the J&J as a whole is still priced way less than all the sum of its parts. So you're still getting a huge discount on this company. And even with that chart I showed you earlier, they're very undervalued. So you are going to get this stock, that's currently priced at only 16.4 times this year's projected profits and 15.5 times next year's earnings estimates. That is really good for a lot of companies, other companies that are trading in the 20s plus. So again, very undervalued in my opinion, and it's a good buying opportunity. Now, they have this little thing that says the kicker down here. This has really caught my attention. Investors may also be missing the fact that the company's got 14 drugs currently in development that could generate an average of $4 billion each at their peak. So once these drugs go to market, you have 14 of them that could reach $4 billion each. That is so impressive, and I think that's what this company is focusing on. I think when it comes to medical devices, especially the prescription drug side of things, the pharmaceutical side of things, this is a market, an area that's just going to grow and grow and grow as people age. There's going to be a lot more, things invented to help treat and cure things. So I think Johnson & Johnson is right in step with, focusing on the prescription drug pharmaceutical side and its medical devices, and possibly getting rid of the consumer health side, which is the slowest growth out of all three. So I'm very excited. I think this company will turn into a growth company, but for now you're getting a great dividend and a great buying opportunity. So that's why I'm buying J&J. Now, for stock number 2, we are going to be buying, or I will in December, I will be buying Coca Cola. Now, Coca Cola is a beverage company, specifically non-alcoholic beverages. The company provides sparkling soft drinks, water, enhanced water, sports drinks, juice, dairy, plant-based beverages, tea and coffee, and energy drinks. So they are very diverse in beverages, and they operate under many popular names, such as, of course, Coca-Cola, Fanta, Fresca, Sprite, Dasani, Smart Water, Vitamin Water, Topo Chico. I've been actually drinking that more often. It's like a sparkling water. Powerade. There's a lot here. This company really has a good, diverse set of beverages. And so if we look at their fundamental analysis, they're not as good in a lot of areas as Johnson & Johnson, but they're still good. So they're slightly undervalued. They're decent quality. They have good growth stability, and there's going to be a reason why. And their financial health is a little bit low, but I think that will be turning around eventually. That's mainly because they do have some debt I will show you about. So analysts rate Coca-Cola at a 4.3. So it's very neutral. It's basically a hold right now. But I see this, I'm more bullish on Coca-Cola than this for a few reasons. Now, remind you, S&P grew 28.5%. What did Coca-Cola do? Well, Coca-Cola grew only 5.78%. So very far behind the average of the S&P 500, but I am bullish that this will change soon. Now, the one thing that is really good about Coca-Cola is their dividend. They currently pay a 3.11% dividend yield. That is a great dividend to get for a company this stable, this secure, with a brand name that you can recognize around the world anywhere. This is one of the most brands that is recognized globally than any other company. So a 3.11% dividend is great, especially because I believe they are positioning themselves towards some growth. Now, financially, if we look at Coca-Cola's debt to assets, they are on the high side for me. Remember, I said anything below 75%. So they are on the high end of that. They're at 73.4%, but that is because of a recent acquisition. And so I'm not too worried about this. Again, high debt is not necessarily a bad thing unless if it's out of control where they can't manage it. Coca-Cola can still manage this debt. And so let's take a look at their cash flow. Here's their cash flow. It's been decreasing over time, which many people would be like, oh no, right? But they had an acquisition I'm going to discuss shortly. And so I think this cash flow will start turning around in the next year or two, and they'll start bringing in some decent gains. Now, as far as their debt, it has gone up quite a bit up there, but again, acquisition, so they're positioning themselves for some growth, and I think they made a very smart decision, so I'm not too worried about that. Their net income and earnings per share, you'll see their net income has actually been, on average, it's been growing, so that's good. Not like at high rate or nothing. And then their earnings per share have stayed relatively flat. So nothing like alarming. Just would like to see a little bit more growth myself. And then if we look at Coca-Cola's price target, we can see that, right now they're in the 54, 53 range. They have a low price target of 55 and a high of 67. So average of 15.4% growth. So remember, it grew only 5.5% now, but over the next 12 months, it could grow 15.4%. So I think now is the time to buy one of the most sturdy companies out there, Coca-Cola. Now, why am I bullish on Coca-Cola? The biggest reason is they are really setting up to compete heavily with Pepsi in one area, and that's sports drinks. Now, Pepsi has the big name Gatorade, but recently Coca Cola, well, in 2018, they bought a 15% stake in Body Armor. Has anyone heard of Body Armor? It is everywhere now. I hear Body Armor everywhere I go. People I know drink it. My family drinks it. My friends drink it. So this was a smart move. And recently they bought the remaining 85% stake. So they have full control of Body Armor, and they're going up against Pepsi for the #1 spot. That's their goal. And if you look down there, that it says Amazon. So recently, according to Amazon, Body Armor was the best-selling sports drink on the website recently, and that is huge. So mind you, Pepsi still has like 75% of the market share, is now going for that #1 spot, and I think they can do it. I think this was an extremely smart move, and it's going to position them to be back on top again. And to beat out Pepsi somewhere, that is a huge, huge, huge win. So the second thing why I'm bullish is, and this is why I'm okay with their high debt because of this acquisition. They not only acquired a great brand, Body Armor, but they're backing it up with some top-rated advertising. So they recently signed with Coca-Cola, recently signed with WPP, the leading agency in the world by revenue, and its new global marketing network partner responsible for creative media, data, and marketing technology for the company. And so this is just them putting their money where their mouth is. They bought this Body Armor. They want to beat Pepsi. They want to be the #1 in the world. And here's their actions taking place. So if they had all that debt and nothing to show for it, that would be a red flag. But Coca-Cola has the opposite. They are showing for it. They are going after it. And so I'm okay with this because I think in the end, Coca-Cola is going to be a growth stock again. And they can position themselves to, acquire other things and maybe expand outside of beverages. You never know. There can be a huge opportunity for Coca-Cola. So let's see what the future brings for them. But this is why I'm buying Coca-Cola. Now, last stock I will be buying is Vici. Now, Vici is a recent purchase of mine and one that I'm very excited about. So it's an experiential real estate investment trust that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations, including the world-renowned Caesars Palace in Las Vegas. They have a diverse portfolio that consists of 29 gaming facilities, comprising over 48 million square feet, and features approximately 19,200 hotel rooms and more than 200 restaurants, bars, and nightclubs. Its properties are leased to industry-leading gaming and hospitality operators. Now, during the peak of the pandemic, or during all of the pandemic, not one of their properties didn't pay up. So that shows the strong leasing agreements that they have with very quality companies. Vici also owns 4 championship golf courses and 34 acres of undeveloped land adjacent to the Las Vegas Strip. So their goal is to create the nation's highest quality and most productive experiential real estate portfolio. And I believe they are going to do that because they have a few things going for them. But before we talk about that, let's look at their fundamental analysis. Now, they're kind of all over the place here, but their valuation, they're about, at fair value, maybe a little bit overvalued. They're high quality. They have low growth stability. Now, this, I think, rating of low growth stability is mainly due to their high concentration of just being, mainly on the Las Vegas Strip and within entertainment. But over time, they're going to diversify, and I think that growth stability is gonna climb. And their financial health is excellent. So that's one thing I really like about Vici. Now, if we look at their rating, analysts rate it at a 5.1, so slightly more on the bullish side, and a few buys that are recommended. And I think this one's absolutely a buy. Now, remember, S&P 500 grew 28.5%. Vici grew 8.5%. So, they definitely underperformed compared to the S&P 500. But what's going on right now with the new variant is really hurting their stock. I think that's the main reason the stock is down. And so once things turn around for that, we're also going into the winter months where not as many people visit Vegas or these other properties across the country. So I think it's time to shine. We'll be starting in like February, March, and the stock will soar as long as we can keep things under wraps with the pandemic. So one of the highlights with Vici is they pay an excellent dividend. They pay a little over 5% dividend. That is extremely awesome and healthy and high. So you're going to be making a lot in dividends with this company. Their debt to assets is very healthy. It's only at 30.9%. So I really like that, which makes them able to pivot more easily because they're not kind of, held back by that debt. Their cash is great. It's been growing. So I'm very, very happy about that. That shows the strength this company has. And their debt is, it was kind of stagnant, but then it dropped this very last quarter. So that is an awesome thing. That just shows that they have the cash to be able to not only grow, but pay down their debt and pay back their shareholders. So their dividend is extremely safe, and that's nothing that should be worried about. Now, as far as their net income and earnings per share, their net income has declined a little bit. And I think that's because of some acquisitions that they're trying to do. So a lot of expenses are coming with that. And their earnings per share has been relatively flat overall. It kind of was low, went high, and then dropped a little bit. And so we'll just see. I think, again, this whole pandemic is sparking fears again. But with Vici, they do have a price target between $33 and $51. They're now at about 28, 27, I think they've been dropped down to recently. And so there's a lot of upside potential here. And so with Vici, my bull case is they're banking on the experience of their properties, right? And people pay premium for experience. And where do they pay the most? In Vegas, right? So they own a lot of properties on the Vegas Strip. They're going to be acquiring MGM, which owns many hotels on the Strip. So they're just going to expand their portfolio. They're also in different states. I think they'll expand out, their portfolio outside of Vegas in different types of entertainment venues. And they own the property, and then they collect money from the hotels and stuff. So they have a really good business model. And again, people are dying to be entertained, and they always will be. And Vegas, to me, will be the top entertainment destination in the world for the rest of my life. So with Vici, I think with a little bit of patience long term, this one's going to pay off huge, and it's the one I'm most bullish about out of the three. So again, I'm going to be buying Johnson & Johnson, Coca Cola, and Vici. Vici has the most growth opportunity for me, but has the most risk because it is newer, it's more concentrated, but I think it has the most opportunity to grow. Then Johnson & Johnson. I think this company will become a growth company again. And because they're spinning off that, one segment that's not growing like the others, the consumer health, that is a very smart move by leadership, and I really like that. So I'm really excited to see where this goes. And Coca-Cola, I think, is going to start, growing more than it has recently because of its Body Armor acquisition. And let's see what else they do in the future. This is Coca-Cola, right? One of the most iconic brands in the world in the history. And so I'm excited to own Coca-Cola. So all these three, I think, yes, they lag the S&P 500, but I think it'll be a different story in the coming years. And so that's why I'm choosing to buy these now in December while they're kind of low, right? So let's talk about quickly three that are on my watch list. One is AbbVie. This is a company that I think is going to continue to develop new drugs that they'll put out there. And, I think with their high dividend and stuff, this is one that it won't be a huge part of my portfolio, but it's one that I'm betting on. I think it will do well. It's about 116 per share right now. So if it drops below 110, so if it goes to the low 100s, I will buy and pick up some AbbVie shares. The second stock on my watch list is 3M. Now this company, it's for its industry, it's very well known. You see its products everywhere. Just go to Home Depot, look, 3M, probably around your house you have stuff that's 3M. And so right now it's like 174 a share. If it goes into the 160s, like even 169, I will be buying 3M. I think long term this company will remain strong and it will grow. I don't think it's a high growth stock. It's more medium to low, but it has a very good dividend. And then lastly, the big dog, Microsoft. This company you can buy at any time and just kind of be assured that a year from now you're going to make good money. They're one of the most financially healthy companies in the world. They have an amazing business model, and Microsoft just has a lot going for it. And so Right now, since I have invested heavily in it, it's one of my, I think it's my top stock in my portfolio. I'm not, so quick to buy it, but if it drops to the low 300s, I think it's 334 right now, I will buy. So there you have it, guys. There's the 3 stocks I'll be buying, the 3 in my watch list, and kind of my opinion on this new variant. And so I hope you guys really like this video. Let me know what you plan on buying. Any of the ones that I showed you today, or what are you bullish on now in the month of December? Now that the stock market's a little bit more volatile and has dropped some, what stocks do you think will be good turnaround plays? I'd be really excited to hear. So please subscribe to my channel if you like this content. I appreciate your viewership. I hope you guys have a great day, and we'll see you next time on Mark's Finance and Fitness.